Picture this. You stop at the gas station and fuel costs are suddenly much higher than yesterday. Then you head to the grocery store, and somehow, your regular shopping bill has gone up again. At the same time, you hear that gold has reached another record high, even though people on TV keep saying the economy is doing just fine. So what's really going on? These price jumps aren't random. Whether it's oil, gold, wheat, copper, or natural gas, commodity prices tend to move for a handful of reasons, and those same patterns show up again and again. Once you understand what drives them, the market starts to make a lot more sense. In this video, we're going to break down the biggest forces that move commodity prices. We'll skip the confusing jargon and focus on what actually matters. By the end, you'll know how to look at a commodity chart and understand the story behind the price movement, instead of just guessing. Part 1. Every commodity price comes down to one simple idea: how much is available versus how much people want to buy. But that doesn't tell the whole story. The important question is, which side is changing, supply or demand? Let's start with supply. Prices often jump when something suddenly reduces the amount of a commodity available. A drought in Brazil can damage coffee or sugar crops, pushing prices higher. A war can disrupt exports from a major producer. And when OPEC decides to cut oil production, less oil reaches the global market, which usually sends prices up quickly. Now look at demand. Demand changes are usually slower. When the economy is growing, factories need more copper, steel, and oil. During a cold winter, households and businesses use more natural gas for heating. If China's manufacturing sector speeds up, it consumes huge amounts of raw materials. If it slows down, demand for many commodities weakens. Here's the pattern experienced investors watch. Supply shocks are usually sudden, while demand trends take time to develop. If a commodity price shoots up overnight, the first question should be, did something happen to supply? If prices have been climbing steadily for several months, the more likely reason is that demand has been increasing over time. Once you start separating supply-driven moves from demand-driven trends, commodity markets become much easier to understand. Part 2. One of the biggest mistakes beginners make is ignoring the US dollar. Most major commodities, like oil, gold, copper, and wheat, are traded around the world in US dollars. That means the value of the dollar has a huge impact on commodity prices. Here's why. When the US dollar becomes stronger, people in countries like India, Germany, or Brazil have to spend more of their own currency to buy the same amount of oil or gold. As commodities become more expensive for them, demand often slows down, and prices can fall. When the dollar becomes weaker, the opposite happens. Buyers outside the US can purchase commodities more cheaply in their local currencies. Higher demand can then push commodity prices higher. That's why you often hear people say, gold is rising because the dollar is falling. It's not just a saying. There's a real economic relationship behind it. A simple example is the US Federal Reserve. When it raises or lowers interest rates, the value of the dollar often changes. As the dollar moves, commodity prices frequently react within days. That's why experienced traders keep an eye on the dollar before making decisions about commodities. Part 3. Interest rates and the Fed. Now, let's talk about interest rates, because this is one factor that quietly moves commodity prices more than most people realize, especially when it comes to gold and silver. Think about it this way. Gold doesn't pay you anything just for holding it. There's no interest, no dividend, nothing. So when interest rates are high, keeping your money in a savings account or buying government bonds suddenly becomes much more attractive because your money is actually earning a return. Compared to that, holding gold becomes less appealing. Economists call this the opportunity cost of holding a non-yielding asset. But when interest rates start falling, that changes. Cash and bonds earn less, so the advantage they had over gold begins to disappear. That's why gold prices often rise whenever the Federal Reserve hints that it's about to cut interest rates. For commodities like oil and copper, the story is a little different. Higher interest rates make borrowing more expensive, which slows down businesses and consumers. Construction projects get delayed, factories produce less, and fewer goods are shipped around the world. When economic activity slows, demand for raw materials also drops. That can put downward pressure on the prices of industrial commodities. So even though the same interest rate decision affects gold, oil, and copper, it doesn't affect them for the same reason. Understanding that difference is what helps you make sense of how commodity markets really move. Part 4. Commodities aren't digital assets. They're real, physical products. Oil has to be pumped out of the ground, wheat has to be harvested, and copper has to be mined and shipped across the world. Because of that, geography and politics have a huge impact on prices. Take oil, for example. Around 20% of the world's oil supply passes through the Strait of Hormuz. If tensions rise between Iran and other countries, oil prices often jump immediately. Nothing even has to happen. The possibility of a disruption is enough to make traders nervous. The same pattern shows up in agriculture. Russia and Ukraine are among the world's biggest wheat exporters. When the war began, global wheat prices surged within days because markets expected supplies to be disrupted. Copper is another good example. Chile and Peru produce a large share of the world's copper. If miners go on strike or political unrest slows production, global supply tightens quickly, and prices usually move higher. That's why professional commodity traders don't just analyze charts or economic data, they also follow world news closely. A political crisis, a war, or even the threat of supply disruptions in a few key countries can have a bigger impact on commodity prices than many economic reports. Part 5. One thing most people never pay attention to is inventory data, but for oil and natural gas traders, it's a huge deal. Every week, government agencies release reports showing how much oil or natural gas is sitting in storage. Think of it as checking how full the warehouse is. If there's more oil in storage than expected, it usually means people aren't buying as much as analysts thought. That's a sign of weaker demand, so oil prices often fall. But if storage levels are lower than expected, it means supply is getting tight, or demand is stronger than expected. In that case, prices can jump within minutes. The reason these reports matter so much is simple. They're based on real data, not guesses. Most of the market runs on expectations and predictions, but inventory reports tell traders what's actually happening. So if you ever see oil prices suddenly move without any major news, there's a good chance an inventory report was released. For short-term price movements, these reports are often more important than headlines. Part equals 6. Here's something that surprises a lot of people. Commodity prices don't move only because people are buying or selling the physical product. Most trading happens in futures markets, contracts to buy or sell a commodity at a future date. Hedge funds, banks, and professional traders buy and sell these contracts every second, and many of them never take delivery of actual oil, gold, or wheat. If millions of traders expect oil prices to rise, they start buying futures contracts. That buying pressure alone can push prices higher, even before any real shortage exists. That's why commodity prices sometimes seem disconnected from today's news. Markets don't just react to what's happening now. They constantly price in what traders believe will happen next. And if those expectations turn out to be wrong, prices can reverse just as quickly. That's why you often see a sharp rally followed by an equally sharp correction. So, what's the big takeaway? Commodity prices don't move because of just one reason. They usually change because several things happen at the same time. It could be supply and demand, a stronger or weaker US dollar, interest rate decisions, wars or political tensions, inventory reports, or even traders placing big bets in the futures market. Most of the time, it's a combination of 2 or 3 of these factors working together. That's why commodity prices can seem so confusing if you're only looking at one thing. I hope this video made commodities a little easier to understand. If you enjoyed it, hit the subscribe button because on this channel, we break down how markets really work